A few weeks ago, I did something that a lot of financial advisors would probably tell you is a terrible idea. I asked a free AI to build me a complete investment portfolio from scratch. I gave it my income, my savings, my risk tolerance, my age, and my financial goals. Then I asked it to tell me exactly where it would put my money if it were me, which funds, which accounts, which order, and why. And here's the thing. What it came back with wasn't generic. It wasn't vague. It wasn't the kind of wishy-washy, it depends on your situation answer you get from most financial content online. It was a specific, reasoned, step-by-step investment plan, the kind of thing that would cost you several $100s to get from a human financial advisor, produced in about 45 seconds for free. Now, I want to be upfront with you before we go any further. I am not a financial advisor. The AI is not a financial advisor. Nothing in this video is financial advice. What I'm showing you is a tool and a method. What you do with it is your decision. But if you've ever felt like investing is too complicated, too risky, or only for people who already have a lot of money, this video might genuinely change your mind. Let's get into it. Before I show you the prompts and the actual output, I want to address the reason most people never start investing at all. Because it's not what most finance content says it is. It's not laziness. It's not a lack of money. It's not even a lack of interest. It's paralysis. Specifically, the paralysis that comes from not knowing where to start when there are thousands of options, conflicting advice everywhere you look, and a very real fear of losing money you worked hard to earn. The traditional solution to that paralysis has been hire a financial advisor, which costs money, or spend months educating yourself, which takes time most people don't have. AI offers a third option, and it's one that didn't really exist 2 years ago. You can now have a genuinely intelligent, detailed conversation about your specific financial situation with a tool that has read essentially every major investing book, research paper, and financial planning framework ever written. And it will talk to you like a human being, not like a terms and conditions document. It won't replace a qualified advisor for complex situations, but for the vast majority of people who just want to know how to sensibly start investing their savings, it is remarkable. Here's exactly how I used it. The first thing I did was give the AI as much context about my situation as possible. This is the most important step. The quality of what you get back is directly proportional to the quality of information you give it. I used Claude for this because in my experience, it handles nuanced financial reasoning better than other free tools. But ChatGPT works too. Here's the exact setup prompt I used, and I want you to notice how specific it is. I want you to act as an experienced, fee-free financial planner. I'm going to share my full financial situation with you, and I want you to help me build a sensible investment strategy. Please ask me any clarifying questions you need before making any recommendations. Here is my situation. I am age years old. My monthly take-home income is amount. My monthly expenses are approximately amount, leaving me with amount available to invest each month. I have amount in savings currently sitting in a standard bank account earning minimal interest. I have no significant debt other than describe any debt. My investment timeline is approximately X years. My risk tolerance is low, medium, high. I would not be comfortable seeing my portfolio drop 20% in a bad year if it meant higher long-term returns. My goal is retirement, house deposit, financial independence, general wealth building. I have never invested before. I have some experience with Describe. What investment strategy would you recommend for someone in my exact situation? Now, fill in those brackets with your actual numbers before you send it. The more honest and specific you are, the better the output. When I sent this, Claude came back with 2 clarifying questions before giving me any recommendations. It asked about my country of residence, because tax-advantaged accounts are different in every country. And it asked whether I had an emergency fund in place first. That second question is important. The AI correctly identified that before investing a single penny, I needed 3 to 6 months of expenses sitting in an easily accessible account. Not invested, just saved. That's your financial safety net. and no good investment advice skips it. Once I confirmed I had that covered, it gave me its full recommendation. Here's what Claude recommended, and I'm going to walk through each part of it, explain what it means in plain English, and tell you whether I agreed with it. Step 1. Max out your tax-advantaged account first. The AI's very first instruction was, before you put money anywhere else, contribute the maximum you're allowed to into a tax-advantaged investment account. In the US, that's a Roth IRA or a 401k. In the UK, it's a stocks and shares ISA. In other countries, there are equivalents. The reason is simple, and the AI explained it clearly. The government is essentially giving you free money in the form of tax relief. Not using a tax-advantaged account before investing in a regular account is like leaving free money on the table. Every pound or dollar you invest inside a tax wrapper grows completely free of capital gains tax. Over 20 or 30 years, that difference is enormous. If you're not sure which account applies to you, use this prompt. I live in your country. I am employed, self-employed. What are all the tax-advantaged investment accounts available to me? How much can I contribute to each per year? And which should I prioritize first based on my goal of your goal? Step 2. The core portfolio. 3 funds. Once the tax-advantaged account question was settled, the AI built a 3-fund portfolio. This is a well-established approach in personal finance. It's not something the AI invented, but it explained it in a way that made more sense than anything I'd read before. Fund 1. A global index fund. This is the engine of the portfolio. A global index fund holds tiny pieces of thousands of companies across the world. The US, Europe, Asia, emerging markets, all in one fund. When the global economy grows, this fund grows with it. When individual companies fail, it barely matters because you own such a small piece of each one. The AI recommended this make up 70 to 80% of my portfolio. Fund 2. A bond fund. Bonds are essentially loans you make to governments or companies in exchange for regular interest payments. They're less exciting than stocks, but they're also far less volatile. When stock markets fall sharply, as they do periodically, bond funds tend to hold their value or even rise slightly. They are the stabilizer in the portfolio. The AI recommended 10 to 20% here and noted this percentage should increase as I get older and closer to needing the money. Fund 3. A small allocation to an emerging markets fund. This is optional and slightly higher risk, but the AI included it because emerging economies like India, Brazil, and Southeast Asia are growing faster than established markets, and a small exposure to that growth can meaningfully improve long-term returns. Recommended allocation, 10%. So the full portfolio, 75% global index fund, 15% bond fund, 10% emerging markets, rebalanced once a year to maintain those percentages. Step 3. Specific fund recommendations. This is where it got really useful. I asked Claude to name specific, low-cost funds available in my country that fit each category. Here's that prompt. For each of the 3 fund types you recommended, global index, bond, and emerging markets, please name 2 or 3 specific, low-cost funds available to investors in your country. For each fund, tell me the fund name, the provider, the annual fee OCF or expense ratio, and where I can buy it. The AI named specific funds with specific fees. It explained that the annual fee, called an expense ratio in the US or an OCF in the UK, is the single most important number to look at when choosing a fund, because even a difference of 0.5% per year compounds into a significant amount over 20 years. It recommended sticking to funds with fees below 0.25% per year. Most of the funds it suggested were between 0.07 and 0.20%. For context, actively managed funds often charge 1 to 1.5%. The AI's recommendation would save me thousands in fees over a decade. Step 4. The monthly contribution plan. Finally, it told me exactly how to split my monthly investment amount across the 3 funds, set up automatic payments so I never had to think about it, and recommended a specific strategy called pound cost averaging, which just means investing the same amount every month regardless of what the market is doing, rather than trying to time it. The logic? Nobody, Not professional fund managers, not AI, not anyone can consistently predict when markets will go up or down. Investing regularly on a fixed schedule removes the temptation to try and over time produces better results than attempting to find the perfect moment. After the initial recommendation, I did something I'd encourage you to do too. I pushed back. I asked harder questions. I wanted to see how the AI handled challenge and nuance. Here are the 3 questions I asked and what it said. Question 1. What if the market crashes right after I start investing? I asked this because it's the fear that stops most beginners from starting. The AI's answer was one of the clearest explanations of market volatility I've ever read. It said, a market crash shortly after you start investing is actually the best thing that can happen to a long-term investor who is still in the accumulation phase. When markets fall, your regular monthly contribution buys more units of the fund at a lower price. When markets recover, and historically they always have, over any 10-year period, those cheaper units are now worth more. The people who lose money in crashes are the ones who panic and sell. The people who keep buying through a crash and come out the other side typically do exceptionally well. It then showed me historical data from past market crashes, 2008, the 2020 pandemic crash, and what happened to investors who stayed the course versus those who sold. Question 2. Should I invest or pay off my debt first? My situation had a small amount of credit card debt. The AI gave a nuanced and genuinely helpful answer here. It said, compare the interest rate on your debt to the expected return on your investment. Credit card debt at 20% interest should almost always be paid off before investing because no realistic investment reliably returns 20% annually. A low-interest student loan at 4% is a different calculation. Market returns have historically averaged 7 to 10% annually, so investing while carrying low-interest debt can make mathematical sense. Use this prompt to get a personalized answer for your situation. I have the following debts. List each debt with balance and interest rate. I also have amount available each month that I could use for either debt repayment or investing. Given a realistic long-term investment return of 7 to 8% annually, what is the mathematically optimal way to split my monthly amount between debt repayment and investing? Show you're working. Question 3. How do I know if this advice is actually good? I asked Claude directly, how do I verify that your recommendations are sound and not just plausible-sounding nonsense? Its answer was refreshingly honest. It told me to cross-reference its recommendations against 3 sources: the work of John Bogle, who founded Vanguard and pioneered index fund investing, the book, The Little Book of Common Sense Investing, and the r/personal finance and r/UK personal finance communities on Reddit, which have extensively peer-reviewed basic investment advice. Everything it had recommended, it said, was consistent with the consensus view of the evidence-based personal finance community. Not a fringe strategy, not a get-rich-quick scheme, just the boring, consistent, low-cost approach that the data has supported for 50 years. I checked. It was right. I want to spend a moment being honest about the limits of this approach, because I think credibility matters more than hype, especially on financial topics. There are 3 things AI cannot reliably do for your investments. First, it cannot predict the future. No AI, no matter how sophisticated, can tell you which stock will outperform the market next year. Anyone or anything claiming otherwise is wrong. The 3-fund index approach the AI recommended works precisely because it doesn't try to predict anything. It just captures the broad market return over time. Second, it cannot account for your full emotional relationship with money. A good human financial advisor can sit with you, understand your anxiety, and help you build a strategy you'll actually stick to when things get hard. AI can get close, especially with a long conversation, but it's not the same. If you have significant wealth or a complex financial situation, a fee-only human advisor is worth the cost. Third, tax and legal advice requires a qualified professional. AI can explain how ISAs or Roth IRAs work in general terms. It cannot give you personalized tax advice for your specific circumstances. For anything involving significant sums, inheritance, business ownership, or complex tax situations, speak to a qualified accountant or financial planner. Within those limits, though, For a regular person who wants to start investing sensibly, understand their options, and build a simple long-term strategy, AI is genuinely transformative. And it's free. Here's what to do after this video ends. Open Claude at claude.ai or ChatGPT at chat.openai.com. Both are free. Paste in the setup prompt I showed you, fill in your actual numbers, and send it. Follow the AI's clarifying questions. Answer them honestly. Take the portfolio it builds and cross-reference it against the sources it mentions. Then, and this is the most important step, actually open the account and make the first investment. Even if it's a small amount, because the single biggest mistake in investing is not a bad fund choice or imperfect timing. It's waiting until you feel ready. Nobody ever feels completely ready. The best time to start was 10 years ago. The second best time is today. All the prompts from this video are in the description below. Copy them, use them, and if you want me to go deeper on any specific part, ISAs versus SIPs, Roth versus 401k, how to actually open a brokerage account, drop it in the comments and I'll make that video next. One last thing before you go. I want to know, are you currently investing anything each month? Yes, no, or thinking about it? Drop it in the comments. I read every single one, and it genuinely helps me understand what to make next. If this video was useful, the like button is one tap, and it helps this channel reach people who are searching for exactly this kind of content right now. Subscribe if you want to see what's coming next. Next Thursday, I'm covering something very different. I gave AI my entire grocery shopping list and asked it to rebuild my weekly shop from scratch with a 25% lower budget. It found $180 in monthly savings without removing a single thing I actually care about eating. Practical, specific, and genuinely surprising. That's Thursday. See you then.